Hi, this is Brad with Credit Sense. I want to welcome you to this week's video. We're talking about fractional reserve lending and how that impacts mortgages and the importance of your FICO score to save you money over the term of your mortgage. Now, as you recall, we talked about fractional reserve lending in another section, and what you'll find is fractional reserve lending puts a bank in a situation where they have an advantage monetarily. All they need to have in cash reserves is 10% of any loan that they're lending out to someone. So for instance, our example was, if you have a $200,000 mortgage, over that 30 years, you're going to pay a percentage of interest based on how much time has elapsed. But the key to that is, regardless of the term of the loan and regardless of the amount of the loan, the banks only had to come up with 20% cash capital to be able to give you that loan. $200,000 mortgage, they only have to have $20,000 on their books to be able to lend that. The other 180 is created, if you will, and so they are in a position where they are made whole at $20,000. Now the key of this, though, for you as a consumer is that as you pay your interest, you're going to see most of the interest is paid in the first 5 to 10 years. That's why you find you have prepayment penalties a lot of times with different mortgages. You're going to also find that your FICO score is the key to making sure you get the best rates on interest so that you save the most money over the term of the loan. Looking right here, for the first year with a mortgage, you're going to pay 5.4% interest. Second year, you've paid 11% of the interest that's going to be paid on that particular mortgage. Third year, at 16% has been paid. At the fifth year, 36.5% of the interest you're paying on that mortgage has been paid back to the banks. They were made whole at $20,000. This is one of the key points. If you're one of those people, it happens, unfortunately, where bad things happen to good people all the time. If you're facing a foreclosure, if you're facing a short sale, just know the banks have been made whole and they're covered. There's also a lot of different things they have as far as insurances and different components that they put in place to make sure that they're made whole when a foreclosure does come into play. So just know it happens to a lot of good people. If it's happening to you, hey, find somebody who can help you through this challenge and get past it, because we want you to get on the path to making money, to being financially secure, and to having a FICO score that you can be proud of. If you look here at the 30th year, a mortgage is at 104%. That's the interest that has been paid. Everybody's happy, obviously. And the key to this, though, is making sure you get a FICO score that's in a Tier 1 category. So a Tier 1 is going to be a 760 and above. It used to be 720, but in 2008, that changed quickly as the economy started to take a turn for the worst. So 760 and above is now Tier 1. Get up into the Tier 1, get the best interest rates, save the most money on your loans. This is Brad with Credit Sense, and this makes sense to me.